Ladies and gentlemen, if you've been following the silver market, you just witnessed one of the most dramatic crashes in precious metals history. In just 2 weeks, silver plummeted nearly 50% from its all-time high. We're talking about a metal that broke through $100 per ounce for the first time ever in late January 2026, only to come crashing down to around $83 today on February 12th. This isn't just a correction. This is a full-blown market earthquake. And if you're invested in silver or thinking about getting in, you need to understand exactly what happened, why it happened, and most importantly, what comes next. Let me start by setting the stage. On January 29th, 2026, silver reached an all-time high. We're talking about a historic moment where silver finally broke that psychological barrier that traders had been watching for years. The metal had been on an absolute tear, climbing steadily throughout 2025 and into early 2026. In fact, over the past year, silver is still up 162% from where it was 12 months ago. Think about that for a second. Even after this brutal sell-off, silver has more than doubled in value over the past year. But here's the thing. When you see gains like that, especially in a market as volatile as precious metals, you're setting yourself up for equally dramatic moves in the opposite direction. So, what triggered this collapse? The immediate catalyst was a decision by the Chicago Mercantile Exchange, the CME, to increase margin requirements on silver futures contracts. On February 11th, they raised the margin from 11% to 15%. Now, if you're not familiar with how futures markets work, let me explain why this matters so much. When traders buy silver futures, they don't have to put up the full value of the contract. They only need to post a percentage as collateral, which is called margin. This allows traders to control large positions with relatively small amounts of capital, which is what we call leverage. When the CME increased the margin requirement from 11 to 15%, it might not sound like a huge jump. But in the leveraged world of commodities trading, this is massive. Traders who were already stretched thin suddenly found themselves needing to either deposit more cash into their accounts or close out positions. And when you're dealing with highly leveraged positions in a market that's already extended, you get a cascade effect. Traders start selling to meet margin calls, which pushes prices lower, which triggers more margin calls, which leads to more selling. It's a vicious cycle that feeds on itself. But here's where it gets interesting. The CME didn't just wake up one morning and randomly decide to increase margin requirements. They do this when they perceive elevated risk in the market. And there was plenty of risk to worry about. Silver had just hit all-time highs, volatility was through the roof, and open interest in futures contracts was at extreme levels. The exchange was essentially trying to reduce systemic risk. But in doing so, they lit the fuse on a bomb that was already primed to explode. Now, you might be wondering why silver was so vulnerable to this kind of move in the first place. To understand that, we need to look at what was driving prices higher in the weeks and months leading up to the crash. There were several powerful forces at play. First, we have the fundamental supply-demand situation. According to the Silver Institute, the silver market is expected to remain in deficit for a sixth consecutive year in 2026, with a shortfall of 67 million ounces. That's 6 years in a row where global demand has exceeded supply. When you have persistent deficits like this, basic economics tells you prices should rise. But it's not just about the overall deficit, it's about where that demand is coming from. Industrial demand for silver has been absolutely exploding, particularly in sectors tied to the green energy transition and technology boom. Silver is essential for solar panels, electric vehicles, advanced electronics, and increasingly for the infrastructure supporting artificial intelligence. Get this. The demand for IT power capacity has increased by 5,252% since 2000. That's not a typo. Over 50 times the demand in just over 2 decades. Silver is at the heart of this technological revolution, and that creates structural, long-term demand that doesn't just disappear when prices get volatile. On top of industrial demand, you had investment demand surging as well. In the first part of 2026, geopolitical tensions were elevated, there were serious concerns about Federal Reserve independence and U.S. policy uncertainty, and investors were looking for safe haven assets. Gold and silver benefited enormously from this flight to safety. Central banks around the world have been diversifying away from dollar-denominated assets, and precious metals have been a major beneficiary of that trend. So you had this perfect storm of factors pushing silver higher. Strong fundamentals, persistent supply deficits, surging industrial demand, safe haven flows, and on top of all that, you had momentum traders and speculators piling in as prices broke through resistance levels. When silver crossed $90, then $95, then finally broke through $100, it attracted even more attention. Everyone wanted a piece of the action. But here's the harsh reality of markets. The more extended a rally becomes, the more vulnerable it is to a sharp reversal. The crash wasn't just about margin requirements, though that was the trigger. It was about a market that had gotten ahead of itself, where too many participants were using too much leverage, chasing too much momentum. When prices started to fall, all those leveraged longs had to liquidate, and there weren't enough buyers willing to step in at those elevated levels. The paper market, the futures and derivatives, completely overwhelmed the physical market fundamentals. And that brings us to one of the most important dynamics in the silver market right now, the disconnect between paper and physical. In the physical silver market, premiums remain elevated, delivery times are extended, and dealers are reporting tight supply. But in the paper market, where futures contracts and ETFs dominate, you saw this massive liquidation wave that drove prices down nearly 50%. This is the tension at the heart of silver right now. The physical market suggests ongoing tightness and strong demand. The paper market suggests fear, deleveraging, and profit-taking. Let's talk about what's happening right now as we speak on February 12th. Silver is trading around $83 per ounce, and yesterday it closed at $84.72, up nearly 5% from the day before. We're seeing some stabilization and even a bit of a bounce after the initial crash. From a technical perspective, silver is currently testing a critical support level. Specifically, it's at the 38.2% Fibonacci retracement level, which sits at 81.85. For those who don't follow technical analysis, Fibonacci retracements are levels that traders watch as potential support or resistance based on the mathematics of market movements. The 38.2% level is significant because it often acts as a battleground between buyers and sellers after a major move. If silver can hold above 81.85, it suggests that buyers are stepping in and we could see a more sustained recovery. If it breaks below that level, we could see another leg down, potentially testing the 50% retracement level or even lower. The next few days and weeks are absolutely critical for determining whether this was just a shakeout of weak hands and overleveraged speculators or the beginning of a longer-term bear market. Now let's talk about what could happen next, because that's what everyone really wants to know. There are several scenarios we need to consider, and I want to be balanced here because anyone who tells you they know exactly where silver is headed is either lying or delusional. Markets are inherently uncertain, especially after extreme moves like we just saw, but we can look at the factors that will likely drive prices in the weeks and months ahead. First, let's consider the bullish case. The fundamental supply deficit hasn't gone away. 67 million ounces of shortage doesn't disappear because of a paper market sell-off. Industrial demand remains strong, particularly from sectors like solar energy, electric vehicles, and electronics. While the Silver Institute forecasts a 2% decline in industrial fabrication to around 650 million ounces in 2026, largely due to efficiency improvements in solar panel manufacturing, that's still a massive amount of demand. The physical market remains tight, and if investment demand returns, we could see a powerful rally from current levels. Geopolitical tensions haven't eased. Concerns about monetary policy, inflation, currency debasement, and financial system stability all remain in play. These are the kinds of conditions that historically drive investors toward precious metals. If we see another wave of safe haven buying, silver could recover quickly. Some analysts are projecting silver could reach $175 or higher by the end of 2026. That might sound crazy after a 50% crash, but remember, we're still up over 160% from a year ago. The long-term trend could still be intact. There's also the matter of short covering. After a crash like this, a lot of traders likely establish short positions, betting on further declines. If silver stabilizes and starts to rally, those shorts could be forced to buy back their positions, creating a short squeeze that amplifies the upward move. We've seen this dynamic play out in silver before, and it can lead to explosive rallies. Now let's look at the bearish case. The margin requirement increase shows that exchanges are worried about excessive speculation and volatility. If volatility remains elevated, we could see further tightening of margin requirements or other regulatory measures that dampen speculative activity. The upcoming Chinese Lunar New Year, which runs from February 16th to 23rd, could create liquidity concerns. Chinese markets will be closed, and this often leads to reduced trading activity in thinner markets, which can exacerbate volatility. There's also the profit-taking factor. Many investors who bought silver at $40, $50, or $60 are still sitting on substantial gains even at current prices. Some of them might decide to take profits and move to the sidelines, especially after experiencing the emotional roller coaster of the past few weeks. And let's not forget that some analysts believe the run-up to $100 was partially driven by speculative mania rather than just fundamentals. If that's the case, we could see prices settle at lower levels as the market finds a more sustainable equilibrium. The industrial demand picture is also not entirely clear-cut. The forecast 2% decline in fabrication is small, but it does represent a reversal from the growth we'd seen in previous years. If thrifting in the photovoltaic sector continues, meaning manufacturers find ways to use less silver per panel, that could weaken one of the key pillars of industrial demand. So where does that leave us? Here's my take. The crash we just witnessed was primarily a function of overleveraged positions being forced to liquidate after the margin requirement increase. It was a paper market phenomenon that doesn't fundamentally change the underlying supply-demand dynamics. The physical market remains tight, structural demand from industry remains strong, and the macroeconomic conditions that favor precious metals haven't gone away. However, the market clearly got ahead of itself in January, and some consolidation or even further correction could be healthy for the longer-term bull market. I think we're likely to see continued volatility in the near term as the market digests what just happened and establishes a new range. The $80 to $85 area could act as support if buyers step in aggressively. If that support fails, we could test the $70 to $75 zone. On the upside, if silver can reclaim $90 and hold it, that would be a strong signal that the bull market is resuming. The key is to watch how the market behaves around these technical levels and pay attention to whether physical demand continues to support higher prices even as the paper market goes through its gyrations. For investors, this crash presents both risk and opportunity. Risk, because further downside is certainly possible, especially in the short term. Opportunity, because if you believe in the long-term fundamental case for silver, buying on a 50% crash could look very smart a year or two from now. The important thing is to manage your risk, avoid excessive leverage, and make sure any silver investment fits within your overall portfolio strategy. This is not the time to bet the farm on a quick recovery. This is a time to be thoughtful, patient, and strategic. The silver market just reminded everyone that volatility cuts both ways, and that lesson is worth remembering whether prices go up or down from here.